I now hand the conference over to Mr. Anant Daga, Managing Director, TCNS Clothing Company Limited. Thank you, and over to you, sir.
Thank you. Good evening and welcome to our Q1FY21 earnings conference call to discuss operational and financial performance for the quarter. I am joined by Venkat, our CFO, and SGA, our Investor Relations Advisors. First of all, I hope you and your near ones are safe and healthy. It's been a long fight against the pandemic that has impacted all of us in one way or other. In terms of business too, it's been unprecedented times. Operations remained highly impacted with complete lockdown in April, followed by staggered unlocking with continuous disruptions for the rest of the quarter. As such, the first quarter has been a clear aberration for the entire industry. While Venkat will take you through key financial highlights for the quarter, let me share the emerging scenario and key focus areas updates. As on date, we have about 85% of our EBOs, LFS, and MBO counters functioning with restricted operational days and timings. We have seen gradual opening of stores starting May and hope to have all of them operational in next 3 to 4 weeks. Talking specifically of first quarter, we had about 65% of our stores open by June end, but in terms of like-to-like operational days for the entire quarter, the number was just around 20%. Planned periodic lockdowns and ad hoc closures across geographies have prevented all these stores from being fully operational. Store sales are currently tracking around 40% of pre-COVID levels on normalized operational period basis. High streets are seeing better traction than malls and airports. Areas with limited COVID impact are seeing much faster recovery, with many of these stores clocking over 70 to 80% of pre-COVID numbers already. We have seen some spike in sales in last 3 weeks on back of Eid, Raksha Bandhan and Independence Day. This clearly shows continued appetite for the category among consumers. However, the situation remains uncertain with pandemic still not in control, and it will not be right to draw any trend lines basis these green shoots. Online has seen sharp growth and as of now is tracking about 1.25x against pre-COVID levels. Our own brand.com is doing 2x of pre-COVID levels and is accelerating. Apart from general shift of consumers to online space in given circumstances, what has really worked for us is also our readiness in terms of robust marketplace presence backed by best-in-class certified operations. This is a journey which we had set ourselves 18 months back, and we believe this could be a key differentiator for us both in short and long term. Talking of back-end operations, our offices, warehouses, our manufacturing partners are now operational and gradually scaling. As mentioned in the last call also, we have drawn a comprehensive COVID response plan. Given the pandemic, our approach towards FY21 is clearly cut out. The key goal is to preserve the strength of our balance sheet. The objective is to minimize cash burn and yet not lose the ability to scale up at an opportune time and strive to reach pre-COVID metrics by FY21 exit. We have set a 5-pronged approach to navigate the situation to achieve this goal. We are focusing on controlling costs, conserving cash, engaging our consumers, building organizational resilience, and seizing potential opportunities. There are multiple initiatives underway in each of these areas, and I'm happy to share that we have made rapid progress on all these fronts. Let me give a quick update on the same. The first bucket is cost control. The two main items here are rent and salaries. We have taken swift action on both these fronts. Given our positive relationships with landlords, we have been able to get significant concessions and waivers across majority of our store network. As on date, our projected annual savings against last year is already at 25% plus levels, whereas compared to contracted rates that include escalation clauses and new store full period rental, this number would come close to 30%. We have accounted for savings of 19 crores in Q1. This does not include potential savings from ongoing negotiations yet to be signed off. We are confident of building meaningfully on these savings as we move forward. Now, apart from renegotiation on leases, we have decided on shutting down bottom performing stores with unsustainable rentals. We have closed 16 such stores in Q1 and have about 25 additional stores under consideration. We are also consolidating our brand presence in select locations in the same store to optimize rental and operational costs. As of now, we have identified about 10 such stores. On staff costs, we have taken a graded salary cut in the organization, which will be reassessed as per evolving situation. We are also rationalizing front-end sales staff strength to ensure safety norms, optimize common resources to manage large format counters for W and Aurelia, and combining reserve staff for multiple locations. Overall, we are targeting a potential 20% plus annualized savings on this front as well. Since most of the initiatives have been taken May onwards, the bigger impact would be seen in coming quarters. Here, I would like to specially call out the zeal and the passion the entire team has shown in these tough conditions. This is exemplary and instills tremendous confidence in our ability to emerge stronger from this crisis. A big thank you to all our employees. Concrete steps have been taken in minimizing all discretionary spends. Marketing is being optimized by using social media platforms and direct engagement tools, and spends have been limited to backing online and offline sales. Meaningful savings have been planned in travel costs, retainers, multiple corporate overhead items. All cost heads are being scrutinized through zero-based budgeting approach, and flexibilities in our cost structure are being optimized. Coming to second bucket, it's all about cash conservation. Even after 5 months of lockdown, and hopefully with the worst behind us, as on date, we have around 125 crores in cash and additional unutilized bank limits over and above the same. Given the cost controls and limited inventories buy going forward, this positions us strongly to tide over the current crisis. The focus is now to release cash invested in working capital, especially in an inventory. Since our last call, multiple steps have been taken on this front. Existing SS20 stocks are being redeployed in the coming season, sharply reducing new purchase requirements. Given the season agnostic and versatile occasion usage range architecture covering over 90% of our product line, we will have a comprehensive festive appropriate offering for our consumers. To add to this, most of the new capsule ranges that are needed to plug the gaps in the product offering are being majorly created out of existing range and leftover fabrics from earlier seasons, further limiting new fabric purchases. Another liquidity lever for us has been vendor credit. We have been paying our suppliers ahead of time, which will be paused for now. However, we will continue to be equitable partners and support our vendors. CapEx is being restricted to existing stores and select key ongoing projects till situation improves. Third area for us is consumer engagement. One very clear and interesting learning through our consumer interactions is that there is untapped demand which is currently not being serviced due to limited accessibility to stores. We are addressing this through both online and non-conventional offline approaches. Our omni capabilities are now being extended to third-party marketplaces as well, bringing us a step closer to being a truly single inventory view business. With our highest rating with leading portals, matching their exacting standards for services and extended product catalog to marketplaces, we are now in a position to service our online customers with a complete range of products. The rising share of marketplace operation is a clear indicator of the efficacy of this capability. On the offline side, we have launched multiple direct-to-consumer non-conventional initiatives. We have taken a hyper-local approach, setting up pop-up stores at residential societies across regions. As of now, we have already done the pilot concept with 50 plus locations and are looking at an accelerated scale-up. We have also been offering our customers a virtual store tour and shopping experience. On this front, we have got really encouraging response. Fourth bucket is organizational resilience and leveraging technology. We had talked about the lockdown giving us an opportunity to take a fresh look at the business model, various work streams, and accelerate key initiatives already underway. Our quick replenishment module, reducing thought-to-shelf times, and launch test scale models are all initiatives that will have high impact on product sell-through and inventory going forward. We continue to invest in building data sciences capabilities and inventory automation processes, which will further strengthen business decision making. Talking about opportunities, we have taken initiatives like 11, which is our new coordinated brand, W's Footwear and Aurelia Girls Wear range. We had invested in working capital for these initiatives before COVID. Now the same would be used in the coming season. We are not committing further capex on these initiatives till the time, but we'll test these concepts in large format doors and online platforms with clear focus on gaining deeper insights, and sharpening our consumer proposition. Now, while we understand that this pandemic has forced all of us to focus on short-term priorities and manage immediate risks and challenges, we need to balance this with long-term objectives. Our balance sheet strength and our response strategy gives us the confidence of emerging stronger from the pandemic, and we remain committed to our long-term growth strategy. I will now request Venkat to take you through the numbers, post which we can open the floor for questions. Thank you.
Thanks, Anand. Good evening, everyone. Hope all of you and your near ones are keeping good health. As Anand said, this has been an unprecedented quarter with significant disruptions to business, and the results reflect the same. Our Q1 revenues was 32 crores this quarter versus 280 crores previous year quarter 1, down 88% versus last year. April was a zero revenue month with staggered unlocking of stores in May and June, while having to deal with stop-start operations in multiple locations. Online has seen strong recovery starting June. Our gross margin this year, Q1, was 51% versus 67% last year Q1. In line with our dormancy provisioning policy, we have taken a provision this quarter also, which on the low sales base makes the gross margin dip look optically higher in percentage terms. Channel mix also had a role to play on this low base, which should stabilize with retail coming back to full operations. There are no challenges on product cost side, and we continue to be in full control on that side. With respect to cost, as Anand mentioned, we have secured a reduction of around 20% in our fixed cost on the full year basis. The savings will come in phased manner over various quarters. There are multiple steps being taken, and we are confident of building on this number as we go forward. Under Ind AS 116 accounting, total rent concession of 19 crores have been accounted in Q1, out of which rupees 7 crores has been reported under rent expenses, that is to the extent available, and balance of rupees 12 crores is reported under other income. This does not include potential savings from multiple negotiations underway which are not signed off yet. We are hence confident of building on this number as we move ahead. You will see a reduction of 12% in salaries this quarter versus previous year quarter 1. We have taken a greater reduction of salaries only from May, and hence bulk of the savings will start from Q2 onwards. Other expenses have reduced by around 40% versus Q1 previous year on back of various cost control measures and renegotiations. At the current rate, the savings is even higher as some additional expenses, example warehousing, were encountered only after Q1 last year. Our EBITDA for this quarter was a loss of rupees 26 crores versus last year's Q1 EBITDA profit of rupees 60 crores. Our Q1 profit after tax was a loss of rupees 45 crores versus a profit after tax of 30 crores last year Q1. We closed 16 stores and opened 8 new stores during this period, including 11 stores. These stores were already in pipeline as of March. Our working capital remains at similar levels that of March. We have taken concrete steps to release cash from working capital, and you will see the impact in second half of the year. The strength of our balance sheet is reflected in our cash position, which is at a healthy 125 crores as of now in mid-August. This, along with unutilized cash limits, keeps us in a comfortable position to fulfill obligations and provide growth capital. Thank you. We are now open to questions. Since we are the only listed entity in our segment, we might not be able to share granular details that might be competitive information. Would request your understanding of the same.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avi Mehta from IIFL Securities. Please go ahead. Avi, your line is in talk mode. Please go ahead.
Hi, can you hear me?
Yes, sir. You can go ahead, please.
Sorry. So hi, Anand and Venkat. Just 3 questions from my side. One, if you could kind of just help understand your thoughts on the discounting levels in the industry that you see. Why we clearly see the industry under a lot of strain. Are you expecting this to result in higher discounting or lower discounting? The reason why I say lower is because, there is a consumer who is clearly valuing safety and putting that in the top of the mind as of now. Or do you see that changing? Your thoughts on that would be useful.
Yeah, hi, Ravi. See, first of all, let me tell you, after probably, at least couple of years and multiple seasons, for the first time we have seen USS actually starting on a delayed date. Every year since last 3 years, every season it has been advancing. So I think the industry together has already taken a step of delaying the USS as we speak right now. I think why this also happened was because, in June, and typically when the USS starts in June and early July, the kind of shoppers we saw in the market were all serious buyers. I don't think they were coming out as the price is an attraction. They had a need and they wanted to consume. And hence, there was no point in putting up USS. So that's why most of the retailers, in fact, I would say majority of the brands, irrespective of their stress and pressure, I think postponed the USS. Number two, see, most of us would be carrying a good amount of excess inventories to next season. And hence it makes no sense to offer any offers there. So that way, we believe that at least for this July, August USS, you'll see a lesser impact. You can still see comparable schemes to last year that one would have had, but overall quantum is definitely going to be lower. How it will span in the upcoming USS next season and onwards is something that a lot will depend upon how brands and retailers perform over the next 6 months. But as of now, we see a lower discounting trend for sure.
Okay. That's actually heartening to hear. Do you see while you're extending the inventory over 2 seasons, are you concerned about inventory being at risk, or you possibly needing to do any obsolescence or provisions for inventory due to this pandemic?
So, I think it's a very important question, and I'm sure many people would have this in mind. So, first of all, let me just tell you that from over last 7-8 years, we have had a very consistent, strong dormancy policy in place. And irrespective of times and external situations, based on seasonality, on a rotational basis, we keep adding dormancies. So every season, whatever is S-3 and older, start getting provisioned as per our historic realizations of the product. So as far as dormancy is concerned, I think we are extremely strong. In last 8 years, we never had to, write down any further losses whenever we sold old inventory. We have always written back. So I don't think there's any challenge on that front, number one. Number two, when you look at our inventory, about 30% of that is fabric. So now that again will be used. So there's not a big challenge there. In finished goods also, if you look at it, majority of that is less than 2 seasons old and fresher. This inventory that we talk about, which is empty, which is more than 90%, which is less than season -3 and current, it's very, very fungible. Unlike many other segments where you have a big season factor and all, our inventory is mostly seasonal agnostic. And also the versatile occasion usage, which is light occasion and casual, which is sold throughout the year in the country with different proportion and different season, can be utilized easily season over season. So we don't see a risk in terms of obsolescence. Or the important question to answer is relevance for the consumer. I think we'll have relevant inventory. The only thing is, yes, some part of this inventory we might have to carry forward more than what we like, which is fine. So we are not blindly reallocating all the SS20 inventory to NF20. We are also carrying a little bit of that to SS21, which is more season appropriate. But overall, we don't see too much of a challenge. We have adjusted our buys accordingly going forward. We are using our existing fabrics to create capsule ranges to strengthen that. But as of now, we think we'll have a much more solid offering for the consumers while still managing the sanctity of the inventory that we have.
Perfect. That's very good to hear. The last bit, Anant, is, prior to this pandemic, there was a clear focus on, increasing the drops at the store, making the supply chain more agile. This has probably the pandemic has kind of made it a little more important or focus area of it. But I was just trying to kind of hear your thoughts because I hear you on the near term focus on cash conservation and you seize opportunities, but I would love to hear what are your thoughts on this aspect of this business and how are you working on that. That's all from my side.
Yes. So obviously, frankly, when we started this initiative of more responsive supply chain, the pilot test scale model, I think those were at that point in time good things to do, nice things to do. But post-pandemic, wherein it's very difficult to put your finger on one number and say with confidence that it is just saying 5% up and down, I think what all the companies have to be ready with is a very agile supply chain, which can seamlessly cater to different scenarios altogether. And I think this is where this will become extremely important. And if you look at the benefits of something like a responsive supply chain, I think they're so immense that once you are able to put it in the regular circulation of your business, I think that's something which will stay with you for a very, very long time. And you would like to build on that. So both from short-term and long-term perspective, I think this is one key area along with, Omni that we talk about, which has got really accelerated because of COVID. And I'm glad that, in the Q3 and Q4 before COVID, we were able to pilot and, reach reasonable accuracies on those supply chain mechanics. So this is an important initiative and it will come very, very handy to manage fluctuating demand situation.
So, Anand, any update on what all have you achieved since then? What is the thought or what are the investment areas that you're looking at? Anything on that front? Is it tech? Is it, the different aspects? I just was hoping that if you could kind of share, what are you doing and how are you going about it, given the scenario we are in? A, planning becomes very difficult and B, implementation also has become a little difficult. So I just wanted to kind of just hear your thoughts on how are you going about it?
So you're talking about supply chain specifically, or you're talking about tech?
Supply chain.
Okay. So the supply chain, what we have done, we ran about 20 pilot runs even before the COVID thing came, because SS20 is when we wanted to start this whole process. The whole idea is if you have a successful product, can you really replenish it in 3 weeks' time? For which you need dedicated suppliers, you need dedicated lines and factories. You need a system internally wherein teams don't work in their functional silos, but as a group between merchandising, designers, sourcing guys, and see this through. So I think a lot of those pieces we have been able to put in place even in Q1. See, in terms of investment, we have used some tech platforms to have better visibility and greater accountability. Beyond that, tech investment in terms of CapEx and all is very limited out there. It's not a big deal. Now, when we talk about responsive supply chain, apart from giving us the ability to really replenish something very fast, what it also does is it helps us reduce the first outright buy quantity of a product. Because now with this capability, you can put a smaller run in the floor, test it out, and if it's working, you can just scale it up. If it's not working, you can just discontinue that. So I think that is the benefit. And in terms of investment, it was a process and it was getting a few units and few people to focus on this, which we have been able to do. Also, what it means is in terms of designing, you will have to be more agile. You will have to simplify the process without taking the essence from the product. That's a continuous learning. We have come a long way and we'll keep building it as we move forward.
Okay. No, the reason why I said
mindset issue than hard infrastructure, frankly, if you ask me.
Okay. No, the reason why I said that is because your slide talked about technology-enabled data science-based decisions. So I was just trying to understand if you made those investments or are you planning to make those investments. I was trying to kind of get some timing.
Okay. Understood. Yeah.
Okay. I'll come back in the queue for the other questions. I mean, thanks a lot.
Thank you.
Thank you. The next question is from the line of Nihal Jha from Edelweiss. Go ahead.
And good evening to the entire management. 3 questions from my side. First one, starting on the gross margin part, you mentioned about the specific reasons why there was a contraction. Now, just looking for the year ahead and considering the three major factors that go into your gross margin, which is say dormancy, discounting, as well as channel. Do you see it coming back to your earlier trends by Q4, by when you're expecting a recovery, or there could be a lower gross margin in the coming time, even in Q4?
So see, on cost side, as of now, we are good. We don't see too many significant challenges. On normalcy percentage side, if the sales return back to normalcy, we should not see a challenge because, as you know, we have also taken aggressive provisioning in Q4 of last year, so we are good there. We don't see any surprise. The third part is all about channel mix, which, if it comes back to the similar levels, would mean getting back to regular gross margin. Otherwise, there could be a minor impact, but not something which is anything major, frankly. So with sales and things coming back to normalcy, we see no reason why gross margin should not get back to earlier levels.
Sure, Anand. And Anand, the second question on that is that as we are focusing and even online as a share is significantly increasing, so the gross margin for that channel without getting it in numbers is similar to the average, or it's one of the lower channels at this point in time?
So for us, it's somewhere in the middle. It's not the most highest gross margin channel, but having said that, it's also not on the lower end. If online significantly increases, you could see a slight dip in gross margin, but again, it won't be very significant. It also depends on how the full price in EBOs and do, which is a high gross margin channel for us. So it depends a lot there. But anyway, I don't think there will be a significant dip on that count.
That's helpful. Last question, Anand. Even some of the other retail companies have been mentioning of Q4 being a quarter where you expect things to come back to normal. The specific question is that is this based on specific assumptions that you're building, or it's more of a hope that things get back to normal by Q4? Just your thoughts on that.
No, so Nihal, there are two things out there. As I mentioned, when we talk about Q4 exit metric also, in terms of actionable, what as a company can we do? We can have the capabilities in place, we can have the flexibilities in place, and we can control cost and manage cash better. So that the day when it comes, when the external environment stabilizes, you'll be able to run up immediately. So I think our approach is more from an actionable point. See, looking at Q4, frankly, guessing right now it's a guess at the best, right? Because see, we don't know how pandemic will pan out. We don't know what kind of stance the administration and local governments will take. So there are all these ifs and buts. Now, I won't say it's just a hope. It's a preparation for that. What gives us hope is probably a couple of things that we have seen in the market in the recent past. For example, first of all, in all our D2C experiments, they are not big sales turners. But what we realize is the moment you reach the consumer's home, they are buying. So there is a latent demand. And probably today supply side issues are as big as demand side issues. So that will get resolved with passage of time, number one. Number two, we have also seen a lot of green shoots in terms of last 2-3 week sales. Wherein, when an occasion comes and a reason to buy is there, people have come out. And third, there are areas which were less impacted by COVID to start with, and where the store has been working without interruption. I think the recovery rates are far better than most of the other places. So I'm just trying to say that if pandemic is in reasonable control in next 3 months, actually you should see meaningful recovery, and then one should build from there to Q4. But exact situation again is something which will depend on many factors. Difficult to predict, but readiness should be there.
Absolutely, Anand, that's very helpful, and I wish you all the best. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Pawan Aluwalia from Laburnum Capital. Before we move to the next participant, we would request all the participants to please limit your questions to 2 per participant. Pawan, you can go ahead, please. Thank you.
Okay. You gave us a good explanation of how you think inventory is going to evolve. On the revenue side, you obviously mentioned that some stores are going to end up getting shut down. And if I look at the last couple of years, revenue growth for us in the industry hasn't really panned out as we would have expected, right? And this is maybe it's partly the economy, partly people being aggressive in introducing private labels. I'm not sure what it is, but we've had slower growth than anyone would have expected, say 3 years ago. Now, with this additional complication thrown in and us shutting stores down, what is the kind of normalized revenue run rate that we can realistically expect to see when the environment normalizes? Because it won't just be a matter of demand coming back and mobility increasing. It'll also be a function of the number of stores you're willing to keep open and competition and things like that. And also, if you have any thoughts on kind of what revenue growth could look like over the over the medium term, that would be very helpful. My second question is pertaining to the online piece of things. Now, what we've seen is online players are very aggressive in driving discounts in various product categories, sometimes by creating their own white label competitors, sometimes using other tactics. Is it possible that we've seen them go easy in your category for now, but that there's a high likelihood that this aggression will increase, making online more margin dilutive in the medium term than we currently think?
Okay, to start with the first question, see, I won't get you too much detail because it's something that we have discussed over past also. You are right, last couple of years for the industry overall has not been the best one. But even there, just keeping one-off events like, NBO rationalization and all apart, we were able to grow at a double-digit number, which given the conditions was not very bad, protecting our gross margin. We were expanding continuously with, 40, 50 stores a year and more than, 200, 300 LFL stores. So, my hunch is, see, once the things become normal, which might take whatever 2, 3, 4 quarters, I think that growth should come back. See, India, we still believe that is a very underserviced market. And I don't think that, demand is going to vanish forever. It has to come back. The timing could be questionable. That is number one. Number two, while we look at the overall demand, we should also think about overall supply. So, for example, if you look at our particular segment, which is ethnic wear, you don't have global players out there. You don't have many scaled-up national players. The industry is dotted with fragile, small, most of the time regional local players. And I think there would be some consolidation there also. So I think the pie itself and the share of the pie both will present an opportunity. How exactly it will come around is difficult to say. But given, last 2-3 years that brands have not grown very extraordinarily, and with this event happening, I'm sure demand should come back to a very healthy level. And I have no doubt in my mind that if you look at the midterm thing, I think a lot of companies with stable balance sheets and with good execution capabilities will actually see a good runway for growth. This is what we think it should be. Again, given COVID, while our route to our final destinations could be different, our route to our strategy could slightly vary. But if you look at next 5 to 10 years, I think double-digit teens growth is not something which is very difficult to achieve. As companies, even in the worst year, we have been talking double-digit growth. So not only for us, but I think for most of the good players and scaled-up players, those kind of growth should be possible. So that was one. Second, when you talk about online, it's not that our segment doesn't have competition. Even today, when you go to all these Amazons and Mintras of the world, you'll have a lot of their own private labels. You'll have their white labels. You'll have people who just sell on their platform. But see, every brand finally means something to the consumers. As brands, we just don't operate on a pricing principle. We are not for fancitors. So there are people who value quality, who value a particular design, and they are willing to pay that price, and that is a customer. Other customers are ones who buy us on discounted and annual season sale. That is fine. Those are anyways slightly more flimsy. So I don't think it will have a huge negative impact as long as we take cognizance of the fact that we are maintaining the pricing parity between online and offline, and the important thing for us as brands is not to get swayed by that growth and start discounting. The mistake that most of the brands did in the early days of e-com. I think beyond that it should be fine. Over time, you'll also see most of the brands coming up with specific capsules and SMUs, which is special makeup lines for all these guys, which will work on different dynamics. But that is another channel. Discounting has been a feature there. In fact, if you ask me, full price sale is increasing as we move forward, and COVID has actually given a big thrust to full price sale as well online. So that should equate out to my mind.
Thank you.
Thank you. The next question is from the line of Varun Singh from IDBI Capital. Go ahead.
Yeah, thank you very much for the opportunity. Anand sir, just wanted to understand that you said that you'll be maintaining low profile in terms of offering discount. But don't you think that during current time, if there is intense competition, because we are saying that all retailers' cash is trapped in the form of inventory. So if people rush to liquidate the inventory, obviously it is. We have the advantage that we don't face the risk of inventory obsolescence. So that is the best part. But still, don't you think that customers migrating to value-oriented product, and we also having not too wide a basket to offer to customers during current times in terms of what we call as essentials, because there is a significant rise in work from people doing work from home. So how do you read this? Because also even before COVID, there was a sequential gross margin decline over last 3 to 4 quarters, excluding the fourth quarter. So don't you think that private label competition, discounting, they are still going to haunt us even during current times?
So Varun, I think there are quite a few questions in what you have asked. So let me just address few of them. First, I don't know what gross margin reduction you are referring to. Q4 was a normal quarter, but before that, I think compared to market, we held pretty good on our gross margin. So
I'm saying year-on-year gross margin decline before fourth quarter, the first, second, and third quarter of FY20.
Well, maybe that is because of India's or IGAP, I don't know, but we can check on that. So for our understanding is the gross margin they've been able to hold much better than rest of the market, but we can get into details, no problem. Now coming to your question about discounting, see, it's a function of few things. First is there is consumer pull. Now in such times when June and July people were like they were scared of coming out of home. If you extend bigger discount, you will not end up getting more customers. In fact, you will end up giving discount to the customer who anyways was coming without looking for discounts. So I think most of the brands have been able to make that smart choice and restrict from giving offers. That is number one. Number two, having said that, if you go to the stores today, all the brands are running offers. But again, on part of the merchandise, it is not full store. So I think there the trade-off is clearly visible. Second thing, see, the level of discounting is also determined by your desperation of cash, your ability to carry forward inventories, and your ability to sell it at a better price in a different channel. This is what we have said earlier also. Beyond a particular point, I have other channels where I can make more margin. So I don't discount beyond a point in my store. You are absolutely right. There could be players who are working on shutdown. They might discount. There might be pressures of those kinds. And that is something that we'll have to see as time comes. As long as all the big players decide to move most of their inventory right, I don't think that kind of pressure will come. But having said that, situations are dynamic. It is evolving. You can see something happening 4 months down the line, which is difficult to predict. Second thing, I think you asked a question somewhere around, work from home and relevance. So see, I think this is again a very important point to understand. One of the key reasons why W and Aurelia became national brands cutting across regional taste and preference is because our products are functional fashion. Most of our lines are all about daywear, easy daywear products and light occasion wear products. We are not traditional ethnic. We are not occasion-driven ethnic. So even in today's context, if you look at the fabrics, the silhouette, the kind of products we have, they lend very well to daily usage. Because at the end of the day, it's all about functional fashion. Women want easy-fitting kurtas, palazzos, easy bottoms, which are all cotton, rayon. That is what we make. Yes, we have some part of our line which is wishful, which could be heavy W and heavy Aurelia, 10%, which might not be relevant. So that will carry forward. But I think balance, if you look at it, I think we are good. And since you have raised this point, let me just add that we understand today consumers are tilting slightly more towards casual, everyday, no-fuss products. And we are fortifying these offerings by launching one capsule range, each in W and Aurelia, which will be these kind of products. It will be more cotton-based, more simpler products, and they will be bundling offers and all for people who want to experience the brand and still want a slightly better price or offer on bulk buy. We'll be doing something for them. But overall, I think given this situation, our product ranges do well. And in fact, another point is too early in the day, but since this point is raised, in a lot of our large format retailers, also in our online channels, we are seeing W doing better than any other brand right now in the ethnic category, and Aurelia has really come up because of exact this kind of offering which other traditional ethnic wear brands don't give. So I think this is actually the strength that we can play on big time.
That's very helpful, Anant. Secondly, if you can share, the data in terms of what percentage of our business comes from malls, and in online, what percentage of business we do from our own platform compared to third party.
So see, in terms of our stores, in a normalized scenario, it's about 50-50, slightly higher for high street, and then about around 47-48 for malls and airports put together. Malls would be about 42-43, whatever such number in this range. In terms of online, our own brand.com sites are now contributing to a double-digit percentage of online sales. So overall, at a company level, it's still not very significant, but the good news is it's growing at a very rapid rate, and it's a very, very key advantage which will be built over a period.
Thank you very much, Anant. And just last question, if I may. You said that inventory, we don't see much of risk, provisioning already taken care of. But what about receivables? Because 55 days is the roughly receivable days, and roughly 50% of our revenue comes from large format stores and a long tail of MBOs. Don't you see a risk over there in terms of, considering the current environment?
So first of all, we have actually, while provisioning, we have erred towards the side of conservatism. So even we have taken some provisions in Q4, even in Q1 we have taken additional as per our auditor suggestion and new directives from the institute, where we want ourselves to be more conservative. Frankly, all that has been taken. We don't see further risk. In fact, if you ask me, at this point in time, I think a lot of them will be returned back, but we can leave that aside. Second, in fact, if you see one of the biggest steps that we took last year, which actually had a very adverse impact on our sales number and profitability, was MBO rationalization. Currently, sitting today in this situation, I think that's the best decision we have taken. And we have been able to reduce our credit exposure to MBO. Otherwise, we would have been sitting on a very, very significant credit exposure. So I think it's controlled. But these are times wherein, there's always an odd party or odd customer who can go bust. So we have been more than conservative, honestly, on this front. And I don't think there should be any negative surprise.
So that's very helpful. 125 crore cash that you mentioned, that is at the end of June. Am I correct?
That is today. That is last week.
Right. Thank you very much, Anand. That's very helpful.
Thank you.
Thank you. We would request the participants to please limit your questions to 2 per participant. The next question is from the line of Mithili Balakrishnan from Newmark Capital. Please go ahead.
Thanks for the opportunity. A couple of questions which I had was, one, on this dormancy provision. Could you just help us understand how much was made in the gross margin?
Sorry, could you repeat?
Sorry, I just wanted to get an understanding of the quantum of this provision which was made for dormancy in the current quarter.
So this quarter we have made about 3 crores provisioning. So if you see from the base of 30 crores, it's quite a big number.
Correct. I also wanted to check with you a little bit about, what is the airport stores doing vis-a-vis, the LFS, and also as the next season sort of comes along. What's the kind of feedback that we're hearing from our LFS partners on what kind of shopping they wish to do and how are they seeing the season sort of evolve?
Mithili, your voice was slightly weak. So what I understand is, one, you want to understand about what the feedback LFS has and how they are seeing businesses with brands like us, right? That was one question.
Right. And also about the airport stores. I just wanted to get a sense of what the airport stores are sort of doing currently.
Okay. So airport stores have been the slowest to pick up. And barring one particular airport, all the other airport stores are really struggling. Now, in most of the airport stores where we decide to continue, we have been able to get very attractive lease deals. In fact, a lot of them are revenue shares. And wherever we think, with minimal operational losses we can run, we might still decide to run, because apart from sales channels, these are excellent brand building channel as well. And it's very difficult to get the space. There are few airports where, we might not get the right rental deals, which we'll decide to shut. In fact, in Q1 itself, we have shut about 4 airport stores. So that's what airport. I think that channel will struggle for some time. It will be some time before it picks. Second, if you look at LFS doors, it's slightly early in the day. The kind of feelers we are getting, one is our brands are doing relatively better than pre-COVID levels, especially Aurelia. W always was among the best performing brands across. Aurelia has really come up notches. And what they feel is there's a clear gap in the ethnic category where very few brands are making for day wear. And Aurelia being a more day wear brand has really gained traction. Second, from couple of large format guys, the sense we are also getting is they want brands like us to play a slightly bigger role in upcoming seasons, especially winter and beyond. Because they see a lot of their smaller partners and with 1 or 2 large format, even their private labels might not be able to scale up the productions that they would require for those seasons. So in all probability, we might get some additional spaces and slightly bigger shelf share going forward. But these are early days, so I think we'll have a better hold of the situation in next month or so.
Got it. And my last question is on the cash burn for the quarter. I just wanted to confirm my understanding that over this period from June to August, our cash spend has been 25 crores, or is there something on the limits that we have also utilized?
No, so what actually we have given is as on date, which is like a couple of days back, 125, and we started with 175. So it's been about 50. Okay, and sorry, so from March, you are saying from March or you are saying from June?
Yes, from March.
Yeah. So March actually it's more than 50 crores. But there also see April, our collections and stores are all shut. May also it started trickling down. The real collections and all started happening only in June. Also what we have done is we have taken the buys. We have also paid our vendors. So hopefully the trajectory now onwards would be much, much stronger. And in Q3 we should have a cash break-even month for sure. That's how things are looking right now.
So the cash burn, but over these 4 months has been 50 crores odd.
About 5 months, yeah, slightly more than that. Yeah.
Okay. Got it. Thanks a lot, Anand.
Thank you. The next question is from the line of Vaishnavi Mandani from Anand Rathi. Please go ahead.
Hi, thanks for taking my question. I actually wanted to understand basically, if I look at the pre-Ind AS quarterly run rate of rent that we have, it's somewhere around 30 crores. So on that basis, how much reduction have we gotten? Because I just want to get a little bit more understanding on the rental part.
Yeah, Vaishnavi, actually I think that you are right to look at the pre-Ind AS numbers. Ind AS 116, which was supposed to be for the benefit of analysts, I think has not exactly worked out very well. So pre-Ind AS, yes. So what we right now, what we have communicated is that around 25% on that basis, on the full year basis, we should be able to get.
So the 122 crores of rent what we reported in FY20, so this year for FY21 on a full year basis should be 25% less compared to that.
Yes, you will factor in one thing, of course, there are also explanations etc. for those rentals, but ये ballpark range में आप पकड़ लें.
Okay. And for this quarter, if I may ask, versus that 30 crores of rent, a quarterly run rate that we have, versus that, what reduction or how much
if you look at it this quarter in the P&L, actually we've taken 19 crores savings actually. So इसमें क्या है, we have taken 7 crores in rental and 12 crores in other income.
Yeah.
और 2 crore इसमें है जो
for the next quarter.
There are 2 crores in this, which is for the subsequent quarters, which have been considered in this quarter itself, because those have been signed off.
Okay, so approximately if I do the math, it's a 60% reduction in the rent for Q1, right?
Yes.
Okay, fine.
See, also, Vaishnavi, I think one thing to remember is, as we mentioned earlier also, what is happening is we are not being able to, I mean, the entire market is not being able to get very long-term concessions. Landlords are okay assessing the situation again and again. So all these numbers will be built upon as we move forward. And you might see more savings getting built in subsequent quarters.
Okay, all right. Okay, thank you.
Thank you. The next question is from the line of Vijay Danukap from Motilal Oswal Financial Services. Please go ahead.
Hi, this is Vijay. Hi, Anand. Hi, Venkatesh.
Hi, Vijay.
How are you?
Good. Thank you very much.
Yeah. Hi, Anand and Venkatesh, what I wanted to understand is, we have looked at your quarter one results. Based on the trends that you are expecting for rest of the year or for the month of, say, July and August, would it be right to say that, at a full year level, we will be able to, at least achieve 60 to 70% of our business that we did last year? That's one question. And depending on what the estimation that you have based on trends that you are seeing, would you think that we will be able to, maintain a EBITDA level or a PAT level break even for this business for the full year?
So there is a couple of things out there. First of all, hello?
Yes, I can hear you.
So
the management line got disconnected. We would request the participants to please stay connected while we rejoin them back. Thank you for patiently waiting. We have the management reconnected, so you can go ahead, please.
hello?
Yes, sir, you can go ahead.
Okay. So, see, first of all, as a company, we really don't want to give a guidance. And as we were saying right now, to give one number is really, really difficult.
Right.
Looking at current trends, there's some positivity and green shoot that we are seeing. I think in next 2 months with festive setting in, we'll be in a much more clearer position to see how this thing happens. Because see, there are a lot of factors which are beyond our control.
Right.
Right. So that's one. Your second question was about profitability. So see, the way we are looking at it, this is a very different time. So rather than looking at an annual thing, we are just taking a season at a time from a business perspective, and traction over quarters start to come back to life. Also, the focus of the company right now is frankly much more on cash and to preserve cash without losing the ability to scale up. So I think that focus is much more sharper right now. More than profits, we are focusing there and frankly building capability. Cash on a monthly basis, I think we should be able to start seeing positive flows in Q3. That's given the limited buys, cost control, and improving operations, we feel fairly confident about that. And as far as full year profitability and all, I think we'll just need to sit and wait, watch it out for next few months before forming a firm opinion.
Okay, sure. That's fine.
Thank you. The next question is from the line of Vikas Jain from Equirus Securities. Please go ahead.
Thank you. Thank you, Anand sir. Thank you, Venkat sir, for the opportunity. So my first question is on the MBO channel rationalization that we did even in this quarter. So, what I wanted to ask is, should we expect this to continue further going ahead in the quarter, or we have largely taken on with the all the closures on the MBO front?
So because see, there is no rationalization which has been done this quarter. It's just that, businesses started opening in May and June, and there was very little that you could do with MBOs. Having said that, see, while we were comfortable by end of Q4, post-rationalization, COVID has now again posed a new challenge. There is on depressed sale, again, they are having liquidity issues and all. At this point in time, we are prioritizing credit exposure over sales, and I think we'll wait it out. We'll be supplying to MBOs who would be paying on time. Otherwise, we won't be, pushing sales with credit exposure. My sense is this channel will take the longest, and I don't think one should expect too much from this channel this year. But rationalization exercise was almost done, so I don't think this is any continuous rationalization. Whatever we have left, it's all good to build at the right time.
Right. Correct. And sir, in terms of, as you mentioned that we'll be further looking at some store closures going ahead, and we are considering the same. Can you guide on the capex? How much will we be incurring a capex in terms of any new additions like we did in first quarter also?
So see, two things. First of all, when we are saying we'll be reducing few stores, frankly, that would have a positive impact on P&L, because those were anyways not the best, most profitable stores, or more often than not, they were not making money for us.
Great.
So this lockdown has just, expedited that process for us. So that's number one. Number two, in terms of opening, we had few stores in pipeline which we could open in March. So we had 20 plus stores, out of which we have already opened 8. We are still negotiating 4 or 5, where we are not sure whether we'll be able to open them or not. It depends upon the rental. But beyond that, for time being, unless we get a store which we were looking for and not getting for a long time, or some very good deal, I don't think the focus would be on expansion right now. Right now, the entire focus is on making the existing lease rental deals far more sustainable.
Right. Correct. All right, sir. Thank you. Thanks for the opportunity.
Thanks.
Thank you. The next question is from the line of Jitark Shah from JM Financial Limited. Please go ahead.
Hello?
Yes, sir, you can go ahead.
Yeah, okay. Sir, I just had one question regarding the supply side. So how do you see your fabric units and the contractors being able to furnish the supplies to you? And I know that you mentioned that you have sufficient inventory, but still some sense on that would be helpful. Like how much time are they taking to provide supplies, and are there any labor issues on that front?
Okay. So see, if you look at our supply chain, I think depending upon the regions and geographies, most of them are at different scales or different degrees of scaling up. I don't know whether you are aware of this or not, but about 3 years back, we started a big program wherein we started moving a lot of our manufacturing facilities to rural areas. It was done with a light to de-risk the big city production hub, and also it gave us a lot of cost benefits vis-a-vis a big city production. So those all are doing well. Those all are scaling very fast, and I think that's turned out to be a very, very big asset for us in these times. Some of the city units are struggling slightly more. Similarly, on fabric side also, you have a lot of mills which are operational. Frankly, most of them are running below capacity, so I don't think capacity is an issue at all. If you look at our inventory situation, we have very limited buys for over next 4 or 5 months, and we don't intend to buy anything right now. So, I mean limited buys. So, given our utilization capacity, it's fine. I don't think we'll face any challenge in terms of scalability issues. I think by January, February, when next season's orders will start picking up, it's 6 months from now, 5 months from now, I think a lot of those will get stabilized.
Okay.
So there, from that point of view, we don't see a risk. There could be 1 or 2 particular items or particular kind of stuff which might get into a bigger loop, because at times we source something from very specific clusters, but those again will come back to life, and those are not significant by any means for us.
Okay. Yeah, that's it from my side. Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you. We take this opportunity to thank all of you for joining the call. We hope we have been able to address all your queries. For any further information, please do get in touch with us or SGA. Thank you once again. Have a nice evening. Take care. Stay safe.
Thank you. On behalf of TCNS Clothing Company Limited, that concludes today's conference call. Thank you for joining us, and you may now disconnect.
Bye.